On a Sunday evening in mid-August 1971, somewhere around 80 million Americans had their regular programming interrupted by an unscheduled address from the White House. Richard Nixon sat behind his desk and told the country he was launching a new economic policy. He talked about jobs, about inflation, about beating back currency speculators he said were attacking the dollar. What he did not spell out for a domestic audience, because it barely needed saying to people who weren't central bankers, was that for the previous 27 years the United States had made a specific promise to the rest of the world. Any foreign government holding dollars could walk into the United States Treasury and exchange them for gold at $35 an ounce. That promise was the load-bearing wall of the entire post-war financial order. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. It underwrote the reconstruction of Europe and Japan. It was the reason the dollar functioned as the world's money, rather than merely America's money. And on that Sunday night, without a vote in Congress, without a treaty amendment, without so much as a courtesy call to the finance ministers who had built their reserves on that promise, one man closed the window. The decision had been made 3 days earlier, in near total secrecy, by a small group of advisors at a presidential retreat in the Maryland mountains. Nobody outside that room had a say in it, and by the time the rest of the world found out, it was already done. To understand why a weekend meeting at a rustic mountain retreat could end up rewriting the rules of global money, you have to go back to July 1944, when representatives of 44 allied nations gathered at a resort in Bretton Woods, New Hampshire, with the war in Europe still unfinished. The economists in that room, chief among them John Maynard Keynes for Britain and Harry Dexter White for the United States, were trying to design a monetary system that would prevent a repeat of the 1930s, when countries had devalued their currencies against each other in a desperate scramble for trade advantage and dragged the whole world into deeper depression. What they built was a system in which every currency was pegged to the dollar, and the dollar alone was pegged to gold, fixed at $35 an ounce, a rate that had actually been set back in 1934. Central banks around the world could hold dollars instead of gold bars, confident that a dollar was, for all practical purposes, as good as gold, redeemable on demand. It was elegant. It was also entirely dependent on the United States keeping enough gold in reserve to honor that promise, if enough countries ever asked at once. For the better part of 2 decades, almost nobody tested it. America came out of the war holding roughly 70% of the world's monetary gold, and the dollar's credibility was not in question. The system built at Bretton Woods was not the only proposal on the table that summer. Keynes, representing an exhausted and heavily indebted Britain, had pushed for something more radical, a new international reserve unit he called the Bancor, managed by a global clearing union, rather than anchored to any single nation's currency. Under Keynes's plan, surplus countries as well as deficit countries would bear some responsibility for correcting trade imbalances, which would have limited the advantages available to whichever country's currency sat at the center of the system. Harry Dexter White, negotiating for a United States that held most of the world's gold and was about to emerge from the war as the only major industrial economy left standing, wanted the dollar itself at the center instead. White's version won, decisively, because the United States held the leverage in the room. Keynes returned to Britain frustrated, reportedly telling colleagues that the Americans had gotten almost everything they wanted. The Bancor was never built. The dollar took its place, and every advantage that came with occupying that position, and every vulnerability, flowed from a negotiating outcome decided by 2 men representing 2 governments in the summer of 1944. It also helps to remember that the $35 gold price was not new in 1944. It dated to 1934, and the story of how it got set is its own preview of what would happen decades later. The classical gold standard that had governed international finance before the First World War collapsed almost immediately once that war began, as belligerent governments suspended convertibility to print the money needed to fight. Britain tried to restore it in 1925, at the old pre-war exchange rate, a decision pushed through by Winston Churchill as Chancellor of the Exchequer against the advice of economists including Keynes, who warned the rate was overvalued and would strangle British industry. He was right. Britain abandoned gold again in 1931 as the Depression deepened, and the United States followed a similar path under Franklin Roosevelt, who in 1933 issued an executive order compelling American citizens to turn in their gold coin, bullion, and certificates to the Federal Reserve in exchange for paper dollars, then unilaterally raised the official gold price from just over $20 an ounce to $35 an ounce the following year under the Gold Reserve Act. Roosevelt's move devalued the dollar, effectively wrote down the value of the gold Americans had just been forced to surrender, and was done with the same kind of executive decisiveness Nixon would later apply in reverse. This rarely comes up in the standard account of 1971, but Nixon was not the first American president to unilaterally rewrite the nation's relationship with gold. He was the second. By the late 1950s, the Bretton Woods version of that same bargain was starting to show its own strain. In 1960, a Belgian-American economist named Robert Triffin testified before a congressional committee and laid out a problem that would eventually carry his name. The world needed a growing supply of dollars to lubricate expanding global trade, and the only way to supply those dollars was for the United States to run balance of payments deficits, sending more dollars out into the world than it took back in. But every deficit meant more dollars circulating abroad relative to the gold sitting in Fort Knox, and at some point, Triffin warned, the arithmetic would break the promise. Either the United States would stop supplying the world with dollars and choke off global growth, or it would keep supplying them until foreign holders no longer believed the gold was really there to back them up. Nobody in Washington moved to fix it. Through the 1960s, the deficits kept growing, driven by a war in Vietnam that consumed enormous sums, by the domestic spending of the Great Society programs, and by American companies investing heavily overseas. Dollars piled up in the vaults of foreign central banks faster than the American gold stock could plausibly cover them, and the people running those foreign central banks were starting to do the math themselves. France did the math most publicly. President Charles de Gaulle, advised by the economist Jacques Rueff, viewed the dollar's privileged position with open suspicion, and his finance minister at the time, Valéry Giscard d'Estaing, gave the arrangement a phrase that stuck. America enjoyed an exorbitant privilege, printing the world's reserve currency and effectively borrowing from the rest of the world at no real cost. Starting in the mid-1960s, France began systematically converting its dollar holdings into gold bullion and shipping it home to vaults in Paris rather than sitting on paper claims. Other countries watched, and more quietly, began doing the same. In 1961, the United States and 7 European central banks had formed something called the London Gold Pool, an arrangement to jointly intervene in the market and keep the price of gold pinned at $35 an ounce, even as private demand pushed against it. It held for a while. Then in March 1968, under a wave of speculative buying tied partly to the costs of the Vietnam War, the pool collapsed. The world split into a two-tier gold market, an official rate for transactions between central banks, and a floating private market price that climbed well above it. The gap between what gold was officially worth and what people would actually pay for it was, in hindsight, a warning that the pretense could not hold much longer. By the time Nixon took office in January 1969, the American gold stock had shrunk from more than $20 billion at its post-war peak to roughly $10 billion, while the dollar claims held by foreign central banks and governments had grown to several times that amount on paper. The math Triffin had described in 1960 had arrived. In the first half of 1971, the pressure accelerated sharply. West Germany, unwilling to keep absorbing dollars to defend its currency peg, let the Deutsche Mark float in May, breaking ranks with the fixed system. Speculation against the dollar intensified through the summer. Then, in early August, the British government quietly asked Washington to guarantee the value of roughly $3 billion of its reserves against any devaluation, a request that landed inside the Treasury Department like a fire alarm. If the British, of all people, no longer trusted the dollar to hold its value, the psychological floor under the whole system was starting to give way. Treasury officials reportedly calculated that the gold remaining in American vaults could no longer cover even a fraction of what foreign governments were legally entitled to demand. The gap between promise and reality had become too wide to paper over with diplomacy. That is the backdrop against which Treasury Secretary John Connally, a big, blunt Texan with little patience for monetary theory, assembled roughly 15 officials at Camp David on Friday, August 13, 1971, and told them nobody was leaving until they had a plan. The group included Federal Reserve Chairman Arthur Burns, who worried openly that closing the gold window would be seen as an admission of American economic failure; Paul Volcker, then a young Treasury Undersecretary for Monetary Affairs who had spent the previous weeks quietly drafting contingency plans for exactly this scenario; Budget Director George Shultz, Economic Advisor Herbert Stein, and a handful of others pulled in for the weekend. They worked through Saturday and into Sunday, testing arguments, running numbers, arguing over whether to act unilaterally or try once more to negotiate a coordinated fix with America's allies. Connally pushed hard for speed and secrecy. Burns pushed back, worried about the international fallout. In the end, speed won. There was no vote among the group, no formal dissent recorded, no attempt to bring in Congress, which was in recess, or to consult the International Monetary Fund, whose entire reason for existing was to manage exactly this kind of monetary crisis. 15 men in a wood-paneled retreat decided how the money of more than 1 billion people outside the United States would work going forward, and they decided it over the course of a single weekend. One detail about who was not in that room says almost as much as who was. Henry Kissinger, then National Security Advisor and already the most powerful foreign policy voice in the administration, was left out of the Camp David weekend entirely, since the closure of the gold window was treated internally as Connolly's turf, a domestic monetary matter rather than a foreign policy one, even though it was about to upend America's relationships with every one of its allies. Volcker, by contrast, had been quietly drafting contingency memos on ending convertibility since the spring, and arrived at Camp David already having thought through the mechanics in more detail than almost anyone else in the room. Less than a decade later, as Federal Reserve Chairman, he would be the one cleaning up the inflation that same weekend helped unleash. What they produced was a package Nixon called the New Economic Policy. It suspended the convertibility of the dollar into gold, closing what had been known for decades simply as the gold window. It imposed a 90-day freeze on wages and prices across the domestic economy, an attempt to control the inflation that deficit spending and a weakening dollar were already feeding. And it slapped a 10% surcharge on imports, a blunt instrument meant to pressure other countries into revaluing their own currencies upward against the dollar. There was no existing law that cleanly authorized a peacetime president to unilaterally end gold convertibility, so the administration's lawyers reached for a statute that had almost nothing to do with 1971, the Trading with the Enemy Act of 1917, a law written during the First World War to let the government freeze the assets of hostile nations. Nixon used wartime emergency powers, on the books for more than half a century, to dismantle a peacetime monetary treaty that the United States itself had designed. Nobody in that Camp David retreat seemed to find that legally awkward enough to slow down. Nixon announced all of it on television that Sunday night, framing the closure of the gold window as a defensive move against unnamed international speculators, rather than what it also was, a unilateral American decision to break a 27-year-old promise. The domestic reaction was, almost immediately, celebratory. The stock market posted one of its largest single-day gains in years the following Monday. Nixon's approval ratings ticked upward. Editorial pages largely praised him for decisive action. The wage and price freeze in particular polled well, since it looked to ordinary Americans like the government was finally doing something about the inflation eating into their paychecks. What the initial coverage did not dwell on was how the freeze actually worked in practice, or how long it would need to last. When the 90 days ran out in November 1971, the administration replaced it with Phase 2, a more elaborate system of mandatory wage and price boards empowered to review and approve increases across large sectors of the economy, essentially installing peacetime price controls of a kind the country had not seen since the Second World War. Phase 3, introduced in January 1973, loosened the rules and made compliance largely voluntary, which businesses read correctly as an invitation to raise prices as fast as they could before controls tightened again. They were right to expect that. A brief Phase 3.5 reimposed a price freeze that summer as inflation accelerated regardless, followed by Phase 4, before the entire control apparatus was allowed to expire in April 1974. 4 phases in under 3 years, a great deal of bureaucratic machinery, and by the government's own later assessment, no lasting effect on the underlying inflation rate, which simply resumed its climb once the controls were lifted, this time compounded by an oil shock the controls had done nothing to prepare the country for. The freeze bought Nixon a good news cycle in August 1971 and very little else. The reaction abroad to the gold window closure itself was, from the outset, very different from the domestic mood. Finance ministers in London, Paris, Bonn, and Tokyo learned about the end of dollar convertibility from the same broadcast as everyone else, with no advance warning and no consultation, despite the fact that their own country's reserves, trade balances, and currency values were about to be upended by the decision. It was, by design, a fait accompli. There was nothing left for allied governments to negotiate over because the decision had already been made and announced before they were told it was even under discussion. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything and helps me bring you more emotional stories like this one. The immediate aftermath was a scramble to patch together some kind of replacement system. In December 1971, representatives from the major economies met at the Smithsonian Institution in Washington and hammered out a new arrangement, since remembered as the Smithsonian Agreement. The dollar was formally devalued against gold, with the official price raised from $35 to $38 an ounce, even though actual convertibility remained suspended and would never return. Other major currencies were revalued upward against the dollar, with the Japanese yen and the German Deutsche Mark among the biggest movers, and the negotiators built in wider bands within which exchange rates could fluctuate before central banks had to step in and intervene. Nixon called it the most significant monetary agreement in the history of the world. It lasted about 14 months. By early 1973, renewed speculative pressure on the dollar, driven by the same underlying imbalances that had never actually been fixed, forced a second devaluation, and the patched-together fixed-rate system finally gave way entirely. Currencies began to float freely against one another, their values determined not by treaty or gold, but by supply, demand, and the daily judgment of traders in London, New York, and Tokyo. For the first time in modern history, the world's major currencies were backed by nothing but the trust that governments would manage them responsibly. The new floating system carried risks nobody had fully priced in, and one of them showed up in June 1974, when a mid-sized German bank called Herstatt collapsed after racking up enormous losses trading currencies in the newly volatile foreign exchange markets. German regulators shut Herstatt down in the middle of the business day in Europe after it had already received payments from counterparties in dollars, but before it had sent back the Deutsche Marks it owed in return, since New York was still hours behind. Banks around the world that had done business with Herstatt that day were left holding losses with no counterparty left to collect from, and the episode was serious enough that it led directly to the creation of the Basel Committee on Banking Supervision, the body that still coordinates international bank regulation today. It was a small, technical crisis by the standards of what would come later, but it was also a preview. A monetary system built on floating confidence instead of fixed gold created new categories of risk that simply had not existed under the old arrangement, and regulators were left improvising the safeguards after the fact rather than before. It is worth sitting with how strange that actually is. Every dollar, every pound, every yen in circulation today exists because people agree it has value, not because it can be exchanged for a fixed quantity of a metal sitting in a vault. That arrangement, which now feels like simply how money works, was not designed by economists over years of careful study and public debate. It was improvised over a single weekend in 1971 by a small group of men trying to stop a run on American gold reserves, and it became permanent mostly because nobody ever found a workable way to go back. John Connolly, never a man to soften a point, put the new arrangement to America's trading partners bluntly at a meeting of finance ministers not long after the announcement. The dollar, he told them, is our currency, but it's your problem. It became one of the most quoted lines in post-war economic history, because it captured something true about the position the United States now occupied. America had unilaterally rewritten the terms of the system that every other major economy depended on, and it had done so with essentially no cost to itself and enormous costs distributed everywhere else. Currency reserves that other central banks had built up for decades, denominated in dollars, were now worth whatever the market decided a floating dollar was worth on a given morning, rather than a fixed and guaranteed quantity of gold. The consequences did not stay contained to currency markets. Oil, like most global commodities, was priced in dollars, which meant that as the dollar weakened through the early 1970s, the real value of every barrel a producing country sold was quietly shrinking even if the sticker price stayed the same. Officials in OPEC countries said as much publicly at the time, citing the devaluation of the dollar as one of several grievances feeding into their push for higher prices. When the Yom Kippur War broke out in October 1973 and Arab members of OPEC imposed an oil embargo against the United States and other countries supporting Israel, the geopolitical trigger was unmistakable, but the currency backdrop had been building the underlying resentment for 2 years already. The price of oil, which had sat at roughly $3 a barrel before the embargo, climbed past $12 a barrel within months, and the resulting inflation tore through economies that were already unsteady from the collapse of the old monetary order. Out of that same instability came an arrangement that would end up cementing the dollar's global dominance even without gold behind it. In 1974, American officials, including Treasury Secretary William Simon, negotiated a deal with Saudi Arabia under which the kingdom agreed to continue pricing its oil exports in dollars and to invest a substantial share of its resulting oil revenue back into American Treasury securities, in exchange for military equipment and security guarantees from Washington. Other OPEC members effectively followed Saudi Arabia's lead in keeping oil dollar denominated. The details of the negotiations stayed out of public view for decades, only becoming widely documented much later through investigative reporting and declassified records. The practical effect was enormous. As long as the world's most traded commodity had to be bought and sold in dollars, central banks everywhere had a structural reason to keep holding dollars, gold backing or not. The system that had lost its anchor in August 1971 found a new one in the oil markets of the mid-1970s, built this time on demand rather than metal. That new arrangement had consequences of its own a few years later. The oil-producing states were now sitting on enormous dollar surpluses, far more cash than their own economies could absorb, and much of it flowed into Western banks looking for somewhere to put it to work. Those banks, in turn, recycled the money into loans to developing countries, particularly across Latin America, often on floating interest rates tied to the same dollar that had been drifting and unstable since 1971. It looked, for a few years, like a tidy solution to an awkward surplus. Then Paul Volcker's fight against American inflation pushed interest rates toward 20% at the start of the 1980s, and every one of those floating rate loans reset sharply upward at the same time. Mexico announced it could not meet its debt payments in August 1982, and the crisis spread quickly to Brazil, Argentina, and much of the rest of the region, triggering what became known as Latin America's lost decade, a period of economic contraction and austerity that in some countries lasted the better part of 10 years. None of it traces back to a single villain. It traces back to a chain of decisions that started with a weekend at Camp David, ran through an oil crisis and a new dollar recycling arrangement, and ended with borrowers on another continent absorbing the cost of an interest rate decision made in Washington to fix a problem Washington itself had created a decade earlier. For an ordinary American household in the early 1970s, none of this arrived as a single dramatic event. It arrived as a paycheck that bought a little less every month, as the price of gasoline and groceries climbed in a way that felt untethered from anything happening in their own lives, and as a vague sense, confirmed by nightly news segments about the falling dollar, that the ground under the economy had shifted in some way nobody had explained to them clearly. Domestically, the 1970s that followed were brutal. Freed from the discipline that a fixed gold price had at least nominally imposed, the money supply grew, and inflation, which the 90-day wage and price freeze had only postponed rather than solved, roared back once the controls expired. By the end of the decade, the country was living through stagflation, the miserable combination of high inflation and stagnant growth that mainstream economics had insisted could not happen at the same time. Annual inflation, which had run at around 1 to 2% through most of the 1960s, climbed past 13% by 1979 and briefly touched even higher, while unemployment simultaneously pushed up toward 9%, a combination economists at the time did not have a comfortable name for, beyond stagflation itself. It took Paul Volcker, the same official who had helped draft the Camp David plans in 1971 and who became Federal Reserve Chairman in 1979, to break the inflation, and he did it by pushing the federal funds rate to nearly 20%, deliberately triggering a severe recession that pushed unemployment above 10% in 1982 and drew furious protests from farmers and homebuilders whose businesses depended on cheap credit. The instability unleashed at Camp David took most of a decade and a great deal of economic pain to fully work its way through the system, and the people who bore that pain, in layoffs and foreclosures and shuttered small businesses, were rarely the same people who had been in the room when the underlying decision was made. The longer arc matters just as much as the immediate crisis. Once the dollar no longer had to be convertible into anything, the practical limits on how much the United States could borrow effectively disappeared. A government whose currency is redeemable for gold at a fixed rate cannot print its way out of every problem without eventually running out of gold. A government whose currency floats freely, and whose currency the rest of the world still needs for trade and reserves, can run deficits for a very long time before the market forces a reckoning. That is more or less what happened over the following half-century. American federal debt, which stood at less than $500 billion in 1971, has since climbed past $39 trillion, financed in large part by foreign governments and investors still willing to hold dollar assets because there has never been a fully credible alternative. Economists Michael Dooley, David Folkerts-Landau, and Peter Garber gave this later arrangement a name in a 2003 paper, calling it Bretton Woods II, a system in which export-driven economies, first Japan and later China, accumulate large dollar reserves by keeping their own currencies competitive, and then recycle those dollars back into American government debt, financing American consumption in exchange for continued access to the American market. It is not a treaty. Nobody signed it. It functions the same way the post-1971 dollar system has always functioned, through habit, convenience, and the absence of anything better, rather than through any formal agreement anyone voted on. The 2008 financial crisis and the pandemic years that followed saw the Federal Reserve create trillions of new dollars through quantitative easing, a policy tool that would have been almost unthinkable under a gold standard, where new currency had to correspond, at least in theory, to new reserves sitting in a vault. That arrangement is now, itself, being tested. Over the past several years, a number of countries, including members of the BRICS bloc such as China, Russia, and India, have discussed settling more of their trade outside the dollar system, and central banks in several emerging economies have added to their gold reserves at the fastest pace in decades, a quiet hedge against exactly the kind of dependency the dollar's position has always carried. None of this has come close to replacing the dollar, which still sits at the center of global trade and reserves more than 50 years after it stopped being convertible into anything at all. But the debate over how durable that position really is has moved from academic journals into finance ministries in a way it had not for a long time, and it traces back to the same underlying tension Triffin described in 1960, decades before anyone had heard of Bretton Woods II. None of this is to say the old system was better, or that returning to a gold standard would solve modern problems, arguments that plenty of economists on both sides continue to have. The point is narrower, and in some ways, more unsettling. A decision this consequential, one that reshaped how money would work for every person on the planet for the next half-century and beyond, was made by a small group of unelected officials over a single secretive weekend, using a World War I wartime powers statute as legal cover, with no public debate, no congressional vote, and no advance word to the Allied governments whose economies were about to be upended by it. It worked, in the narrow sense that the dollar survived and the United States avoided a formal, humiliating default on its gold promises. But it worked because the rest of the world had no real alternative and no seat at the table where the decision was made. 50-plus years later, the debate over whether that weekend was a triumph of pragmatic crisis management or a quiet act of financial unilateralism made by a handful of men answerable to no electorate is still very much alive, mostly among economists and historians, largely unknown to the wider public whose money it permanently redefined. Most people who lived through it never learned the details of that weekend at all. They learned that gasoline cost more, that their savings bought less than they used to, and that something had changed, without ever being told exactly what, or by whom, or on what authority. The room at Camp David is still there. The weekend it hosted in August 1971 is the reason the money in your pocket, in any country, is backed by nothing more than confidence, extended to a system that was never put to a vote and never really explained to the people who would spend the rest of their lives living inside it. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.